Okay. Well, thanks so much for inviting us. So this paper is joint work with Motohiro, and it's called the cost of financial frictions for life insurance. So the starting point is that typically if we think about the economics literature on insurance markets, then the pricing and the quantities that we observe in insurance markets, so the equilibrium in insurance markets, is very much driven by the demand side. So you have these theories like the Irish model, where we have the insurance demand over the life cycle, or the demand is driven by informational frictions like asymmetric information or issues with moral hazard. And a large part of this literature assumes that there's an efficient capital market on the supply side in terms of providing these insurance policies. What we're going to try to argue in this paper is that you want to think of insurance companies not really as these rock-solid institutions that don't suffer from any financial frictions. And we're going to argue that these are really important. So we're going to think of insurance companies very much like banks as financial institutions that are subject to these large balance sheet shocks, and that will have an impact on the pricing and the quantities.
Okay.
Okay. So let me give you one slide what the main empirical facts are that we document in this paper. So if you look at markups in insurance markets, so for life insurance and for annuities, then on average the markup is about 6 to 8%. And this has been well documented in earlier work by Jim Cordova and Jeffrey Brown and others. Now during the financial crisis, there was some new remarkable phenomenon that insurance companies were massively discounting these policies. So term and life annuities were discounting relative to marginal cost by 25%. And the life insurance contracts were discounted by as much as 50%. So what that means is that it costs the insurance company $1 to produce insurance, but yet they're selling it at 50 cents. Okay? Now what drives these discounts? So we're going to have an explanation where these insurance companies will be constrained. So they're going to run up against some leverage constraint, and on top of that, there's a regulatory framework in place that allows them to record during certain periods, allows them to record these policies on their balance sheet in terms of liabilities far below the marginal cost of producing insurance. So what that means is that we expect to see larger discounts for those policies where the reserve requirements are looser, and that's in the cross-section of insurance policies. That's exactly what we find. And across insurance companies, we're going to show that those insurance companies that were most affected by these balance sheet shocks, those are the ones that are discounting these policies the most. Now, this is not the only thing that these insurance companies were doing during the financial crisis. So we're going to show that they were also trying to use all the conventional channels that you may imagine to recapitalize. So they were cutting back on dividends. They got large injections from the holding company. They were trying to issue equity at the holding company level. And they were changing their asset allocation to safer assets that count more towards regulatory capital. Now, the way we want to think about this paper is that once you max out all of those conventional channels in terms of internal and external capital markets, insurance companies face a third capital market, namely the product market. And once you have these reserve requirements that I'll tell you about how they work, then insurance companies can recapitalize by selling policies, insurance policies, at a larger discount. So we're going to set up a structural model to actually quantify how important these constraints are. So relative to other parts of the literature, for instance in banking, where people have documented some of these frictions as well, we're going to actually try to quantify what is the shadow cost of these financial constraints. So we're going to set up a model that allows us to do so, and we're going to estimate that model. And sort of the headline number that we're going to get out of this is that insurance companies were willing to sacrifice $5 of their profits to increase book equity by just $1. Okay? But we're going to have this over time and across insurance companies, and I'll show you that as well. So let me give you a very simple example, and if you understand this slide, you know exactly what's going on in our paper. So I'm going to focus on a term annuity from Allianz. So consider a 20-year term annuity. What does this mean? If you buy this product, then for 20 years you're going to get $1. So there's no survival probabilities here whatsoever. Okay? This is just like the simplest product that you would teach in your MBA class, fixed income. Now, in July 2007, Allianz was selling this product for $14.37. Now, what happened between July 2007 and January 2009 is that interest rates went down. Okay, what does it mean? Well, prices should go up. Instead, Allianz was taking down prices. and they were reducing prices to $11.84. And then in July 2009, once the financial crisis kind of relaxed, you see that they finally hiked up prices and increased it to $14.80. Now, what was the marginal cost of producing this insurance in in January 2009? That was $14.56. That is the equivalent portfolio of Treasury bonds. So the economic profit, or in this case loss, is $2.72 for each policy that Allianz is selling. Now, the question is, why are they doing this? Well, as it turns out, the regulatory framework is such, and I'll explain to you how it works, that for this policy, they only had to record $11.47 on the balance sheet. So from a regulatory perspective, Allianz was doing great. So they were raising book equity by 37 cents by selling these policies. So the $5 number that I quoted to you before is the ratio of whatever you lose, the $2.72, relative to the amount of book equity you're generating, the 37 cents. So for this particular product, this number would be $7.35.
What was their rate in the bond market?
Okay, we're going to talk about all of these things. So let me get through the talk. Let me get through the talk, and then we'll do questions.
Give us one number. What's the IRR of 11 and 14? That's just the one right now.
Okay. I'm sure you have a laptop closer than I do. Anyway, so the data that we have for annuities is coming from the Annuity Shopper. That's a website, and since the late 80s, they've been recording these annuity prices. We have a large cross-section of insurance companies. So we have 100 insurance companies, and we have 3 types of insurance contracts. So we have these term annuities that have no survival probabilities in them whatsoever. We have life annuities that pay you $1 until you die. And we have guaranteed annuities. Those are contracts where you get $1 for a fixed period, and then afterwards, you're going to get $1 until you die. The guarantee periods are 10 or 20 years. For life insurance, we use the CompuLife software, which is the software that insurance brokers are using. Again, we have a very large cross-section of 50 insurance companies for the whole panel. We're going to use the survival probabilities from the American Society of Actuaries. But again, for our main results, we can do everything based on term annuities where survival probabilities don't matter at all. Okay? The accounting data is going to come from AM Best, which directly uses the NIAC regulatory filings. So let me just show you the raw evidence that we have, and then we'll talk about the regulatory framework. So what you see here is the markup relative to the actuarially fair value using treasuries. So the horizontal line at 0, that is telling you that they're selling insurance at marginal cost. In normal times, the markup averages to 6 to 8%, which other papers have shown before us. What we want to draw attention to is what happens during recessions. So you see it already a little bit in the 2001 recession, but really like big time in the most recent recession, is it starts selling these policies below marginal cost. Okay? Now the top left panel is for 30-year term annuities, the bottom right panel is for 5-year term annuities. So the effect is much larger, as you can imagine, for these longer term annuities. Our model is going to be consistent with that, and it's going to exploit this cross-sectional variation. For life annuities, you see the exact same pattern. Top left panel is for households that are aged 50. Bottom right panel, households of age 80, so a relatively short maturity. Same pattern. You see very large discounts for these policies with very long effective maturities. For life insurance, again, same story. Here you see that the average markup is a little bit lower. Now, the reason that the markup is lower is that you can lapse these policies. And there's no standard model of lapsation, but insurance companies do price that out. So in case of life insurance contracts, you don't want to think about the level, but much more what our paper is about the time variation. Okay? Now, one thing that may come to mind, which I think is where Chester was going as well, is what about default risk? Okay, so we're going to use treasuries to discount these policies. So there's a couple of things you should know before we try to make those arguments. And if we could make the default story work, then I'm happy to go with that, but I think it's going to be very hard. So the first thing you should know is that there's a state guarantee fund. So these policies are very senior. So before you can sort of think about not being paid by your insurance company, you need to think about an event where all the insurance companies in your state will be wiped out. Okay, so that's the first thing you need. Now the second thing that you should know is that on the asset side, these insurance companies are incredibly safe. So 84% of their assets is in very safe securities, 16% is in riskier stuff. So think of equities and things like that. Now, suppose we take that as an extreme scenario where we think about the case where entire corporate America is going to be wiped out and the recovery rate is only going to be 84%. Historically, this is very low. So of the insurance companies that actually defaulted, the typical loss given default is between 5 to 10%. Okay, so taking 16% is on the high side. What we're going to do is we're going to look at to what extent the pricing is consistent with what we see in the CDS market. Okay, so we're going to get default probabilities by insurance company, and the main observation is that in order to explain the discounts that we document, the default probabilities should be increasing with maturity. While in a typical crisis, what you would expect is that it's more likely you default over the next year than that you default between, let's say, year 5 and 10. Default probabilities are downward sloping in crises. So what you need to explain our prices is that these default probabilities are upward sloping. That's going to be inconsistent with the CDS data. The second observation is that for the insurance policies that have a maturity of 15 years and longer, there isn't even a probability that's smaller than 1 that is consistent with the pricing of 5, 10, and 15-year insurance policies. So by just using default risk, you cannot explain jointly the prices of 5, 10, and 15-year insurance policies. Okay? Now there's another counterfactual that we do. We go all the way back to the Great Depression. Okay? And there's actually amazing data on insurance pricing during that period. And the good thing of insurance companies is they've been around for like more than 100 years, so we have pretty much the same cross-section of insurance companies. So we hand collect that data, and we do the exact same tests as what we do in the recent recession. Now what we're going to argue is that default risk was way more pronounced during that period than during the recent recession, and you don't see any discounts there whatsoever. The main thing that was different is that the regulatory framework that we're going to talk about wasn't there yet. So that started in the 40s. So that again is consistent with our explanation that it's mostly driven by regulatory frictions as opposed to just default risk. So let me show you the numbers. The top panel here is showing you the markup by different maturities, contracts with different maturities. And in the different rows you see the insurance companies, for which we also have the CDS data. So these are the discounts that you see on these policies. These are the default probabilities that you would need in order to explain these discounts. Whenever it says 100%, it means there's no probability smaller than 1 that can explain these discounts. Okay? This is what you get from CDS prices. And there's 2 things that I want you to observe. The first thing is that these default probabilities from CDS prices tend to be downward sloping. Okay? It's more likely you default in the near term than you default at some future point. And the second thing is that cross-sectionally, these probabilities don't line up very well with what you see in terms of the discounts. Okay? So default risk just by itself is not able to explain these discounts as it seems. So let me tell you about the regulatory framework. So the regulatory framework tells you which discount rate you should use for these policies. For annuities, the discount rate is as follows. You use 3% plus 0.8 to dampen the fluctuations in interest rates, times the difference between the corporate bond yield and 3%. Now, there's 2 important observations. One is that this discount rate does not depend on maturity. So we're going to get identification, exogenous variation from the fact that the yield curve is steepening or flattening, which is going to generate different degrees to which this regulation is strict or lax. The second thing is that this discount rate depends on the corporate bond yield. So what that means is that corporate bond yields go up in recessions, treasury yields go down, and that's why the amount you need to record on the balance sheet is a lot lower than what you would get using treasuries. Now for life insurance, the discount rate is even more creative than the one for annuities. So here you see that they have some min operator and a max operator and some arbitrary coefficients in front of them. Again, this discount rate does not vary by maturity, okay, and that's going to give us the variation. So if you wonder what they look like graphically, then the green and the red line are the regulatory discount rates, and we just compare them here to the 10-year treasury rate. The other thing you should note is that they round them up to the next 25 basis points, which explains all of these, like the staggered pattern in these discount rates. Okay? So what happened over time is that once they calibrated these coefficients in the 80s, these rules were quite conservative. And the reason was that interest rates were relatively high relative to this 3%. Now over time, as interest rates have been declining, these reserve requirements became looser and looser. So you see that the amount of reserves that you need to hold relative to the actuarial value fell far below 1 already way before the financial crisis. But our model is going to tell us that you wouldn't discount policies right away whenever the reserve requirement is below the actuarial value. Our model tells you that you only will see discounts when insurance companies are constrained and at the same time you have these loose reserve requirements. Okay? So let me describe the model briefly to you that we're using to estimate the shadow cost of financial constraints. So we're going to have a whole series of insurance products, okay, indexed by little I, so 1 up to capital I. PIT is the price of insurance product I. VIT is the actuarial value, the one computed using treasuries, and think of that as the marginal cost of producing insurance. V hat IT, that's the reserve value. So that one is using the regulatory discount rate. QIT is the demand for insurance product I. We're going to consider downward sloping demand curves. And you have CT, which is the fixed cost of operating the insurance company. So the profits per period for the insurance company are the price minus marginal cost VIT to produce insurance times the quantity you sell, aggregate that across all of these different insurance products, and subtract the fixed cost. Firm value is the present value of all future profits. The dynamics of assets. So assets this period are whatever you had last period. You have the return on assets plus whatever you sell minus the fixed cost. In terms of reserves, you have the return on reserves plus whatever you sell and the liability you have to record for that. Now what is important is that in recording the liability here, you have V hat. In the profits here, you care about the true marginal cost, V, and that's what's driving the wedge. So we're going to exogenously consider a leverage constraint that this insurance company faces. So this is very similar to the macro finance literature now, where a lot of people try to develop these models with financial frictions where firms or banks face leverage constraints. Now, one concern that one may have with that literature is that there's very little quantitative work up to this point to really measure what are the costs of these financial constraints in these models. So we're going to provide direct evidence in a similar model, directly telling you what the cost is of relaxing, or the benefit would be of relaxing this constraint. So we're going to define excess reserves as KT, and KT needs to be non-negative. So you can relax it. We also have a version of this model where you don't have a hard constraint, but it actually becomes increasingly costly to increase leverage. That would work as well. So now the problem from the firm is going to be to set insurance prices in such a way that you maximize firm value subject to these leverage constraints. If you solve that model, then the price for each insurance product is going to take the following form. The first part is the standard Bertrand price. So it's marginal cost times the markup coming from the fact that you have these downward sloping demand curves. And then you have this second term, and that's what I'm going to focus on. So these are the cost or the impact of financial frictions. So whenever V hat is smaller than V, as we have for these products, you can start to see discounts. And you expect to see larger discounts in the cross-section of insurance policies whenever V hat relative to V is smaller. Okay? In the same way, if insurance companies are more constrained, if lambda phi is higher, then you again expect to see larger discounts. So what you need to, the way we're going to identify our constraints, the way to think about this is that we're going to have exogenous variation in V hat over V. Because these regulatory discount rates don't vary by maturity, but insurance policies do, we're going to have exogenous variation in V hat over V. We're going to observe the insurance prices that the companies charge, and that's going to allow us to identify the lambda at each point in time for each insurance company. So how does this work in practice? What we're going to do is on the left-hand side, we're going to have the price relative to the marginal cost of producing insurance policy I by company J. So I is indexing policies, J is indexing insurance companies. Then we have the elasticity of demand here, and we're going to parameterize that one depending on a whole set of firm characteristics. And then we have the term depending on financial frictions. Okay? There we're going to parameterize the Lagrange multiplier, lambda. Now what is important is that each insurance company has one Lagrange multiplier. So the lambda here only depends on J, but it does not depend on I. And that is crucial for our identification. So you're going to have one insurance company facing a whole menu of insurance products. You're going to have variation across insurance policies fixing the insurance company. Okay, and that's going to pin down our lambda J. So what do you need to believe for identification? So the first thing that our model implies is that as soon as you see prices below marginal cost, then at that point insurance companies are constrained. But that's just telling you that lambda is non-zero. So in order to believe the magnitudes of lambda as well, we can actually make some mistakes in specifying the Lagrange multiplier, in specifying the elasticity of demand. What you need to believe is that the mistake that we make in specifying the elasticity of demand is uncorrelated with these regulatory discounts, okay? So as long as the elasticity of demand, so your demand for a specific product, the way in which we misspecify, doesn't correlate in the cross-section of insurance policies with the V hat over V, with the slope of the yield curve effectively, then the estimate for lambda will still be consistent. Okay, so we don't need to specify the elasticity of demand perfectly. We can make some mistakes, but this is the identifying assumption you need to believe in order to believe our lambda estimates. So doing all that, estimating this on a panel of insurance companies and policies, then this is the time series of the cost of financial constraints. You see that it spikes up a little bit in the 2001 recession, but it goes up all the way to, let's say, $5 in the recent recession. So again, what does that mean? That means that insurance companies are willing to give up $5 in terms of profits to raise book equity by $1. Okay? Now, given the fact that we have this for the whole panel of insurance companies, we can actually map out what the cost of financial constraints is for each insurance company at each point in time. So this is the cost of financial constraints for all of these different insurance companies. So the most constrained company that we estimate is MetLife. MetLife was willing to give up $14 of their profits to raise book equity by just $1. Okay? Now, it's positively correlated with the leverage ratio and what happens to your assets in the previous year. The least constrained insurance company is American General Life Insurance, which you may know better as AIG. So it may look a little suspicious at first that AIG is not constrained at all. However, you should remember that this is after the bailout. So AIG was not constrained whatsoever because they were backed by the government. You don't see any discounts in policies. Okay? So in this way, you can map out the entire cross-section of financial constraints during the financial crisis. Now, what I've been doing so far is talk about the pricing of these products. So of course, we also want to understand the quantity side. And if you believe in the default story, like the simple versions of the default model will tell you that if customers are concerned about the default of a company, companies are going to lower their prices. Not obvious why they would do that below marginal cost, but you would also expect that demand declines, okay? We find the opposite. So in our model, what you see is that the companies that are most constrained are actually seeing the largest growth in the number of policies. So they're discounting these policies, which is consistent with a downward shift in the supply curve. They're massively selling these policies, and the most constrained companies discount the most, and they're actually seeing the largest growth in the number of policies, okay? Which again is consistent with this being a supply friction. Now, what about other channels? So I mentioned some of this before. So what you see is that these companies that are most constrained, so horizontal axis again, the shadow cost of financial constraints, those companies also receive the largest injections from the holding company. Okay, so they were trying to recapitalize through internal capital markets. They were cutting back on dividends that were paid to shareholders. And on top of that, they were moving their asset allocation around. So for insurance companies, if they invest their capital in safe assets, then that helps to improve their leverage ratio as well. So you see that companies that are more constrained are moving more of their capital towards cash and safe assets. Okay? So the way we interpret this evidence is that they're trying to exploit all the potential, all the conventional channels to improve your leverage ratios. So they were trying to use internal capital markets, external capital markets. We're working on new evidence that shows that the guys that were most constrained were also the ones that were issuing most equity during this period. But once you max out all of those conventional channels and you're still up against this constraint, then these companies with this regulatory framework have a third channel to recapitalize, and that's the product market. Okay? And the guys that are most constrained are most aggressively using this third channel. Okay? So what are kind of the main takeaways from our paper? So first of all, for household finance, the literature very much focuses on the demand side. So frictions in terms of like adverse selection, moral hazard, and things like that are undoubtedly important. However, we argue that there's a lot more room for work that shows how financial and regulatory frictions affect the supply side and have an impact on the equilibrium in insurance markets. I think we also make a contribution to this recent trend of macro models with financial frictions. So a lot of these models get a huge amount of action by these leverage constraints, but there's very little direct evidence on what the shadow costs truly are. So there's a lot of work that shows that if banks get constrained, something happens to the quantity because measuring marginal costs for, let's say, loans is quite a bit harder. However, what we're doing is we get a direct estimate of the cost of financial frictions, which I think is helpful to see how we should calibrate those models and what the implications are. That's it. Thank you.